Welcome back, everyone. We have an exciting episode to get into. I finally purchased a new stock, a new company in the Story Fund. Now, I know you're wanting to know what it is, so I'll just jump right to it. I finally broke down and I decided it's time to jump in to Palantir. I just looked at Alex Karp's latest interviews and he wowed me and I bought in. All right, that's not it. I'm sorry, Palantir investors. Maybe someday, but that's not the stock that I ended up buying. The one that I bought is Pool Corporation. That's right, like a swimming pool. Pool Corporation is the largest wholesale distributor of pool products and services in the world. It is an absolute beast of a company. It's completely crushed the market. And even though it has had astronomically good performance and it has incredible metrics, which I'm going to be showing you in this video, it's relatively unfollowed. Not many people know about this company, know about its existence. They don't know about its economic models. They don't know about what this company has accomplished. So I think there's a good opportunity here. I've been looking over this company, the fundamentals of it, the leadership of it, what they're doing with their capital allocation, and I'm blown away by how good of a company this is. So I recently have been buying into the company. I bought it last week, and I'm going to be buying more of it in the future. And I want to show you why I'm so excited to own this company. So having said that, we have a lot to jump into in this episode. I'll be going over why I think this company is such a high quality compounder company with incredibly strong fundamentals. And we're also going to be looking at my buying strategy, how much I bought of the company last week, how much I plan on buying in the future, as well as my analysis in terms of valuation, my discounted cash flow analysis, and where I believe the intrinsic value of the company is currently. Now let's go ahead and start off with my portfolio, the Story Fund. The first thing I think is important to point out is that the Story Fund is one of my two portfolios. It's not the only one, and this one's a little bit more risk on. It's highly concentrated into some of the biggest tech companies that are found in the QQQ. Now, I also leave room for other investments when I find them from time to time. For example, historically, I invested in the company Crocs, the shoe company that owns the Crocs sandals and Hey Dude. This is a great company. It's a very fast-growing, I think, undervalued company, but I bought in $1,000 of Crocs when it was at a very low price. The company raced up 80%. So $1,000 went to $1,800, and then I sold and collected my gains. So I have $100 invested here as a watcher, so I can see it up on the list here. But Crocs, I think, is a good example of a company that the investing thesis is similar to Pool. It's a smaller company that's less tracked by the overall market. It's a faster moving company than the average company in the S&P 500. And this one I did really well in. I was excited about this holding. It performed really well. I got 80% gains within a year. It was just a nice company to invest in. I see a lot of similarities with Pool Corp. I bought into it with $1,900. I started buying the company last week. And I think it holds a lot of the same characteristics. Pool Corp is likewise a smaller company. It's not a $100 billion, $200 billion company. Pool Corp right now is a $12.9 billion company. So it's not tiny, but it's also not massive. It's not a gargantuan company. I would even argue, though, looking at Pool Corp and comparing it to companies like Crocs, I would even argue that Pool Corp is a superior company to Crocs. I think it's a far superior compounder, and it has a lot of characteristics that are much better than Crocs, even saying Crocs is a great company. So there's my position right now. I bought in with a small starter position. The reason for doing that is intentional. I see some temporary headwinds, some very temporary economic headwinds with Pool Corp that may cause it to sell off later this year. And buying into a smaller position, only $1,900, allows me to double my position or triple it if the stock price comes down. So if investors become fearful of the company this year, I can keep adding to the position. That's why I didn't go real heavy and buy $10,000 of it. So that's my position right now. Pool Corp's a smaller company. I bought in with a starter position, and I'm excited to own the company. Now, let's go ahead and jump into the analysis, knowing my position and knowing how I'm invested in it. Like I said, Pool Corp is the largest wholesale distributor of pool products and services. Well, what does that mean? Let me translate that to English. Pool Corp is not a retailer. So you can't go to poolcorp.com and buy products off of their website. You can't go to the Pool Corp store and buy products from their retail locations. They don't have retail locations. They don't have an online presence. They don't sell directly to consumers. They are a business-to-business company. They are a supplier of pool products and services. The way that I would look at it is there's this very fragmented market of pool-related products. Think about this for a minute. A lot of people get a pool in their backyard. They look at it as having something fun. They're going to buy the pool. They're going to have good summer parties. They're going to invite their friends over. Their house is going to become the cool house with a pool. This is becoming increasingly popular. Well, a lot of people don't know. They don't envision how much stuff goes into this. They're going to have to construct a pool. Pool Corp sells all of the products to help with construction, everything around it, all the pumps, all the services, all the plumbing, all the tiles, everything that you do in your backyard, all of the tools to be able to install a pool. They help out with that. But then after installing the pool, you're not done there. Pools require a level of maintenance that most people don't realize. They're one of the most heavy things to maintain in somebody's yard. When you look at a pool, you have to, of course, keep the water balance right. The different pH levels, the different temperature, because if you don't have the right chemicals, the right amount of chlorine in a pool, it'll turn into a green swampland. And nobody wants that for their backyard. They don't want a toxic, sludge, dangerous body of water. So you have to keep the chemicals right. And guess what sells all the chemicals to be able to maintain a pool? Pool Corp does. You have to maintain the pumps to run the filters to filter out any debris in the pool. Guess who sells the pumps? Pool Corp. You have to maintain all the area around the pool, the patio, the tiles. Even though that's more competitive and there's different competitors that sell that, Pool Corp sells them as well. That's a big part of their business. Pool Corp sells everything to maintain a pool, everything around that service. Now, the incredible thing about this for Pool Corp is that they are the massive dominant player in a highly fragmented industry. To give this some perspective, Pool Corp is larger in the pool industry than the next 50 competitors combined. That's right. They're bigger than the next 50 combined. So there's no close second. There's no close third. There's a highly fragmented industry, and then there's Pool Corp that has the dominant monopolistic position. So this goes into what I initially found this company to be attractive. I'm looking for companies that are monopolistic and they have high barriers to entry, and Pool Corp is both of those. It is highly dominant in its industry. It's highly monopolistic in its industry. Pool Corp has even been sued multiple times for being a monopoly. They own the pool industry. So every time someone installs a pool, they don't realize it, but they're signing up to be Pool Corp customers for the next decade. So the way to really think of Pool Corp and envision this company is similar to thinking of the Procter & Gamble of pools. They're a large wholesale distributor that sells to other businesses, and they have hundreds of thousands of branded products. Right now, Pool Corp has over 200,000 branded products specifically centered around pools. That's how large of a company they are. So that's what I first find really attractive about this company. A highly monopolistic, highly entrenched business that has a dominant market position in a highly fragmented industry. That leads to other intangible benefits. They have a large moat because of this. They have a lot of pricing power because of this. And they buy up any competitor that even becomes a remote threat to them. And I'll show you some of the ways that they've done this in the past. So that's a little bit of an introduction about the company, but I still want to go over a little bit more of this company profile, because when I was researching it, it took me a little bit to wrap my head around what this company actually does and to figure out this industry. Here's from the investor presentation. So you can look up their investor presentation. This is just one of the first slides of it. And I think it gives a very accurate depiction of what the company does. They are the #1 worldwide distributor of pool-related outdoor living products. Now, the management here is being a little, they're boasting that they're #1, which is great, but they don't leave in other factors like they don't have many competitors. The reason they don't leave that in is because the management doesn't want to draw attention about the fact that they're a monopoly. If they go out and they say, we're the dominant player, we have incredible pricing power, we're a monopolistic company, then when they're called in front of Congress and when they have regulators looking at them, they will use that against them. They will use that as evidence that they are a monopoly. So you have to read between the lines here. They say right here that they're #1, but they're #1 by a landslide. Unlike other markets where there's close second and third players, Pool Corp doesn't have a close second and third. They're the massive dominant player in this industry, and it's not even close. So they're understating it a little bit here. But again, it makes sense. The management can't come out and say they're monopoly. No good management would do that. They're a multi-category, multi-channel, value-add distribution. They have 120,000 plus professional contractors and retailer customers, technology-enabled B2B and retailer support services, 5.3 billion in sales through over 400 sales centers in 12 countries. Swimming pool, hardscapes, and outdoor living, irrigation, and landscaping maintenance products. So they maintain not only the swimming pool, but everything around the swimming pool. So basically, if you're going to install a pool in your backyard, they supply everything for you to do that. Even the landscaping and irrigation around the pool. They're really vertically integrated with the pool business. Over 2,000 market-based sales and customer service representatives. And then this is the big one right here. They have over 200,000 products across more than 50 product categories from over 2,200 suppliers. Massive product category. This is why I say they're like the Procter & Gamble of pools. This massive conglomerate of products that they sell at a different distribution. Now we go into this, and this breaks it up by geographic area. A couple things I'd note from Pool Corp. They don't have any Chinese exposure, which I view as a benefit. They're 90% in the US, they have 5% Europe, and then 5% Canada and another. So you don't have any risk of anything outside of the US, basically. The product and application spend, this is the big one here. This shows the product, or rather the revenue segment breakdown of the company. Maintenance and repair is 60%. All right, 60% of revenue is from ongoing services after the initial installation. Renewing, remodeling, and upgrading is 20%, and the new construction is 20%. So this is part of the confusion about Pool Corp. When a lot of people look at investing in pools, they think, well, Joseph, in 2020, we had an abnormally high amount of pool installations. Everybody was stuck at home, and they all decided to do different backyard projects at the same time. You're exactly correct if you're thinking that. 2020 was abnormal in the way that it was a focus on new homes and pool installations. That for sure helped out Pool Corp. But what I think investors leave out here is that after someone installs the pool, they're not done. They still have to service it. They still have to upgrade it. Things break. They still need chemicals. Pools require monthly service every single month. So this company, after helping to install pools, they're not done making revenue from the customer. They still have a high lifetime value of those new customers. So even though the new construction category, this 20% right here, even though that could go down, the rest of these will continue on, especially the maintenance and repair. So I look at this as a very positive thing. 2020 and 2021 got a lot of new customers for Pool Corp. Customers that have very high returns on capital. And I'm going to show you some of the metrics here. They are staggering. Now they go ahead and break this down into layman terms here on the right. They have this segment here, which is the new pool construction. This part is discretionary. If we go into an economic contraction, the economy slows down, people can't find jobs, they're going to be less inclined to install new pools. I'd also say that it's also fluctuating. For example, in 2020, we had a lot of new installs, and in 2021, but that's probably some demand pull forward. So we're going to see this segment, this 20% of revenue, go down a little bit over the next year. That would be my guess. We can't count on there always being new installs every single year at higher rates. That's just not an assumption I would make. This next segment here, which is replacements and refurbishments, they say that this is somewhat discretionary, and I agree. If we go into a recession, people are going to be more reluctant to upgrade their pools or do refurbishments. So that's somewhat discretionary. And then the non-discretionary part is a part of maintenance. Even if we do go into recession, people are still going to maintain their pool to some degree, which means at least buying their chlorine, making sure their filters work, making sure the pumps work. That's something that they have to do unless they really just want their pool to be destroyed. So this part is a lot less discretionary. So that's the basic breakdown of revenue segments. 40% is economically sensitive, susceptible to big recessions. 60% is more resilient. And I think that's a good mix, but that does leave the challenge of whether or not we go into recession. And I'll be talking about that in just a minute. Another thing I want to highlight about this company is that it has high barriers to entry. It is a difficult company to compete with. Now, starting a pool service company is easy to do. I could spin up a pool service company overnight. I could hire a couple people that know how to service pools. I could come up with a company name. I could buy some products, and I could go door to door to sell that service. But guess what? When I start my pool service company, I need to buy products to service the pools. That's where I go to Pool Corp. So Pool Corp is very difficult to compete with because they own all the products to service pools. And that part is difficult to replicate. So I want to make an important distinction here. There's no barriers to entry to starting a pool service company. That's easy. There's zero barriers to entry. There's huge barriers to entry to doing what Pool Corp does because they own all of these branded products that they have patents on, that they have licensing on that other people do not own. Automatic controls, sanitizing systems. They actually own special chlorine chemical formulations, so they have a big part of that as well. Heater and heat pumps, robotic cleaners, variable speed pumps. A lot of these are very, very difficult to replicate at mass scale and have tons of contractors working with you. So unlike a pool service company, Pool Corp does have high barriers to entry. And then finally, one more thing I want to share that's qualitative about the company is the performance-based culture. A lot of companies like to say that they have performance-based incentives for the executive team, but they really don't. They have the majority of their pay basically set in stone, and then they have like 10% of it being performance-based. In the case of Pool Corp, 80% of executive compensation is linked to long-term stock performance. 80%. Another way of saying that is if the stock doesn't perform, the executives don't get paid. Plain and simple, their payment is based on the stock's performance. If it doesn't go up, they don't get paid. So that's another thing I really like about this company. Now, let's go ahead and move on from the qualitative aspect to the quantitative aspect. We're going to be looking at the actual economics of the company using Qualtrim Insights. If you're not familiar, this is a website that's included as part of the Patreon membership at $10 a month. It comes with a free trial, so you can try that out. But we have here Pool, P-O-O-L, and the stock is right now at $332 per share. Now, the first thing that I'll mention is a valuation of the company, just the quick hand PE ratio. Qualtrim does not have it because Pool Corp just recently bought a new company and the earnings estimates are off. But the management team is expecting, at the bare minimum, to make $16 in earnings per share in 2023. At $16 in EPS in 2023, that puts the forward PE of Pool Corp right now at a 24 PE. So 24 PE for the company, not outrageously expensive, but also not dirt cheap. It's right there in between. It has a slight premium over the S&P 500, maybe 10-15% over the S&P 500. In my opinion, the qualities of this company, their market position, and their economics that we're going to be looking at more than justify that premium. But that's the earnings right now. They're expecting $16. It's trading at $330, so around 24 PE ratio. Now, if we look at the stock price performance, here's what Pool Corp has done historically. I'll bring it up here and we can look at the all-time performance. It's done 35,974% all-time, not counting dividends, which this company pays a pretty hefty dividend, a fast-growing dividend. And 36,000% stock performance is considered pretty good. That's a pretty good performance since 1995. We look at the 10 years. Over the past 10 years, again, not factoring in dividends, it's done 592%. So again, very good, around triple the S&P 500, and it's beat the QQQ. But if we zoom in on the more recent performance over the past 5 years, we can see that it hit its stock price peak in 2021 at $577 per share. And ever since then, it's been in a long-term downtrend for the past year or two. The reason that the stock price is going down is because they, of course, had that huge surge in pool installations right here. Investors got really excited. And then, of course, the market started to sell off. New pool installs are slowing down a little bit. So the stock is coming back down. And there's also the additional fear of investors that we're going to go into a recession and that the pool business is going to do terrible during a recession. That's what's causing the company to sell off. But keep in mind, when investors are fearful about a high quality company that has very good characteristics, many times that's the time to be buying the company. Even this year, if we go to year to date, the company traded up at one point to $422 per share. That is a 40% gain year to date. Then it traded back down to $330. So this is a moving target. It's a highly volatile company, but if you invest in it, you have to know that. You have to know that the stock price is going to go up and down. It's highly volatile. What you want to pay attention to overall is the growing economics of the company, which we can look at here. We look at the revenue of the company over time, and it looks pretty intense. It's grown recently. I would not pay too much attention to the growth since 2021 because part of this growth is through acquisition. So this is not organic growth. They bought another company that made it so they had a steep increase in revenue. Now, the years of 2010 through 2019 are through organic growth. They did lots of smaller acquisitions, little tuck-in ones, but they also grew more because of the new installs in pools. Pools are in a long-term secular growth trend, and because of pricing power. This company won't come out and say it. They won't come out and say that they're raising prices 5 to 10% year over year in all of their products, but that's what they've been doing. They've been raising prices above the rate of inflation for the past decade. So a lot of this has to do with immense pricing power and secular growth trends. The other thing that I notice in their revenue is, of course, the steep decline from 2007 to 2009. That is what investors are really scared of, the recession. Their revenue went down during that time period, and their profitability, their net income, their free cash flow, their earnings per share also went down heavily. It showed a scary, scary picture for investors. If we get into a recession, it may adversely affect the economics of Pool Corp. Now, in my opinion, I think there's substantial differences now of Pool Corp than there was in the 2009 recession. I think the company's far more resilient now, but I also believe that it's highly unlikely that we're going to go into another 2009-like recession. This was a terrible recession, an awful one that was specific to households. A lot of people abandoned their household because they could not afford their mortgage. The chances of us going into a repeat of that, a 2.0 of 2009, I believe is really rare. So I'm not quite as concerned about a repeat of this than I think a lot of other investors are. Now, moving on, we have the EBITDA here. Again, it shows the same trend, the recession hurting the profitability, the organic growth, and then these 2 years, which I would ignore because they're inorganic growth. This is based off of an acquisition. We have the free cash flow here. It shows a very similar trend. But what I'd like to know about the free cash flow is how consistent and resilient the free cash flows are. They've been making solid free cash flows for the past 20 years. All the way back to 1995, they were in the positive free cash flow. It's ebbed and flowed a little bit over time, but it's generally going up. And then we have the explosion in free cash flow as they've done some really intelligent acquisitions. So this company's in very good shape right now. It's a highly free cash flow positive company, and they're consistently generating free cash flow. Not just during good times or bad times, they are consistently generating free cash flow. If we look at the stock-based comp and the dilution of the company, this is also another positive thing. Their stock-based comp last year was $14.8 million. Their free cash flow last year was $441 million. So their stock-based comp is barely anything. It's not a problem at all. And then their free cash flow per share looks incredible. They have very strong free cash flow per share growth over a very long period of time. If we look at the earnings per share of the company, this also shows the same trend. It had troubles in the 2009 recession centered around homes. Again, I don't believe we're going to have a repeat of that type of recession, so I'm not overly concerned about that. But then we also see the strong organic growth of their EPS the following decade. Very strong. We see the step up in 2019 to 2020. Then they've grown it tremendously over the past couple of years. Their earnings per share growth has been astounding. Now, there is going to, of course, be a reversion in their EPS, but the management says it's going to be around $16, which is what it was in 2020. So it's going to go down, but it's not going back down to where it was in 2019. They're going to keep their EPS pretty high, not a substantial EPS reversion. Now, if things go worse than expected and the earnings per share drop way back to where it was in 2020, that's where the company would be in trouble. But with their acquisitions, with all of their new installs, I believe that's highly unlikely. I think that the management is going to be mostly correct. I believe that during the 2023 year, they're going to have earnings per share of around $16. That would put them again right at this red line. So a reversion, but not a massive one. And then after this year, the management believes that their growth will go back towards their normal trajectory. So this is overall an economic growth profile that I really like to see. They're growing their revenue, their free cash flow, and their earnings per share, all at rates above the S&P 500, above the average company. Then we get into their balance sheet. Like I said, they did an acquisition, and instead of diluting the shareholder and issuing tons of shares, they did no dilution, but they instead bought the company in all cash. They had cheap debt at the time, So they chose to finance it through debt, which I believe was the smart decision. Look at this. Their debt spiked from being around $300 million to being around $1.5 billion. So a huge spike in debt, but again, no dilution. They didn't dilute the shareholder. Now the debt, you can see they're paying it back down rapidly every single quarter. It went from $1.5 billion in the second quarter of 2022 to $1.4 billion the next quarter, and then from $1.4 billion to $1.28 billion. So they're paying it down over $100 million per quarter. That's a very fast rate of declining debt. And they're doing this, again, I can stress, without issuing more shares, which is something I really love to see. So even though the company took on a little bit of debt for these new acquisitions, they're paying down that debt quickly, and they're doing share buybacks at the same time. The last year, they bought back 2.59% of their shares outstanding. So even with their little bits of stock-based compensation, they're buying more and more shares outstanding than they're even diluting. They're paying down debt, they're buying back shares, increasing the investors' equity in the company. While they're paying down debt and they're buying back shares, they're also raising the dividend like crazy. This company is a huge dividend payer. They're a huge dividend grower. In 2004, the dividend was 7 cents per quarter. It went from 7 cents per quarter in 2004 to $1. So it's gone up tremendously over the past 2 decades. In the past 10 years alone, the dividend compound annual growth rate is 20% per year for the past decade. Last year, they raised it by 25%. So this company's paying down debt, they're buying back shares, and they're growing the dividend all at once. And they have a dividend yield right now of around 1%. So even though it has a lower starting yield, the dividend growth rate more than makes up for it. I look at lots of companies on Qualtrim. I'm always looking for the best compounders I can find, companies with incredible economics that are priced at a fair valuation. And it's rare to find a company in this category, a company that's buying back shares, paying down debt, raising dividends way above the speed of the market, and it has organic growth rates much higher than the S&P 500. Usually these type of companies trade at tremendous premiums. They usually trade around 27 forward PE ratios up to 35 forward PE ratios. This company's doing all of this while trading at a 20 forward PE ratio, a very modest premium to the S&P 500 for economics that are vastly superior to the S&P 500. When I look at this annually, we can go down to the ratios chart here. This is what Terry Smith looks at with his businesses to find ones that have high returns on capital employed. That's the number one metric that he looks at. This company has incredibly high ROCE. If we look at the long-term history, the ROCE has gone as high as 40% and then as low as 20%. Now, 20% being their low is still very high. Companies like Ford Motor Company, they barely ever get to 20%. Their average is around 7%. Even decent companies like Costco and Texas Roadhouse have their average around 20%. And this is the low for Pool Corp. The average over the past 5 or 6 years has been 35%, which is in that bracket of elite companies. Companies like Estee Lauder, companies that have incredible brand value, incredible pricing power, and are very capital efficient. So this company's ROC is persistently high, and it's been going up over time and maintaining new levels of being very high. And so you have to give credit to the management here. Their compensation is heavily based on long-term returns of making good investments, and they've done that. They're getting very high returns on their invested capital. We look at the gross margins of the business. This is also going up over time. Typically, companies that can grow their gross margins over time outperform the market. There's a lot of data showing that. Companies that can grow their operating margin over time outperform the market. There's a lot of data on that as well. They're obviously growing their operating margins. And the management team years ago said that they're going to get their operating margins above 20%. Now, a lot of investors might not believe them. Management teams say lots of different things, but based on their history, I think they might be correct. I'm not going to be shocked when this company grows their operating margins above 20%. And then we have the profit margins, which are also growing steadily over time. The profit margin last year was 12%, and a decade ago, it was only 4%. So they are optimizing and making their business more and more efficient over time, making it so that investors in the company have a very efficient business that's giving a lot of money back to the investor. That's one of the things I really like about this company. This business is so capital light. It's incredibly efficient. Look at the CapEx here. This is the amount of heavy investments they have to do in opening up warehouses and supply centers and things like that. The amount of CapEx they did in 2020 was an all-time high. So their CapEx is going up over time. Oh no. The CapEx was $43 million. The company does over $6 billion in revenue, and CapEx is $43 million. It's a tiny fraction, less than 0.5%. And it's tiny in comparison to the rest of the company. So they are an incredibly efficient capital-light business. It doesn't take a lot of CapEx to run this company. The amount of R&D they do it's nothing. They don't have any recorded R&D because they don't need it. So this is a company that has such a good business model that when they make all of these free cash flows, they can quickly return that money right back to the investor through dividends and share buybacks. And that's part of why they've had such good returns. So overall, I love the economics of this business. When I plug it into Qualtrim and I look at every different aspect of it, it's very difficult to not like this company. I think any investor that looks at it is going to be floored by the economics. And when I look at my fundamentals, what I'm really looking for and what I want to avoid, we can see how closely this company matches. This is a slide that I made that really summarizes the type of characteristics I'm looking for. I want companies with strong organic growth and revenue, free cash flow, and earnings per share. Pool Corp has that. They have organic growth through pricing power and long-term secular trends in people getting pools. I do not believe that trend is going to end. Pools are awesome. They're fun. Everybody wants to own them. It's kind of like the status symbol of having a nice home now. I see that trend going on for the next decade, and that will lead to continued pricing power. When you look at them demonstrating their pricing power in history, this has been obvious. Talk to anyone that owns a pool. Ask them, have the price of chlorine gone up, or pool pumps or servicing over the past 10 years? Ask them what they say. Every single one of them will note that prices have gone up well above the rate of inflation. Is the company scalable? Meaning that over time, is the company's margins going up as they make more money? I just showed you all of the ratios. The gross margins are going up. The profit margins are going up. The operating margins are going up. All the margins are improving in the company. It is highly scalable. Are they a great steward of cash flow? Tight control over costs. They have incredibly low costs. They keep the employee count as low as possible. They keep the CapEx as low as possible. They only spend where they get high returns. So they are great stewards over the cash flow. Do they have predictability in the cash flow and earnings? I would say that they do. Their history shows they do, except for one caveat, which is a terrible recession. If we have another 2009 recession, then they're not going to be predictable in their cash flows or their earnings. So that is there's always one thing. There's always something that doesn't match perfectly. That is it right there. If we go into another 2009 recession, Pool Corp is going to struggle. The stock price will fall down. It may go from a 24 PE ratio to a 10. So that would be a bummer, but I assess the probability of that happening to be very low. Are they a service-based monopoly? Part of this is service-based, but they also sell branded products. Now, what do I like to avoid? Companies that do the opposite of this. Pool Corp does not have high reinvestment rates. They don't do a lot of CapEx and R&D. Pool Corp has predictable cash flows. Pool Corp does not have intense competition. They're monopolistic. They don't have dual class shares. They don't have wasteful free cash flow. They don't have acquisition-based growth primarily. They have done some acquisitions recently, but their growth going forward is not reliant on that. It's reliant on pricing power and secular growth trends. And then finally, do they have complex operational risks? They do not. In total terms, this is a very simple business. So overall, looking at the company economically, fundamentally, the leadership, the qualitative aspects of the company, I like it. I really like what I see overall. I think it's a very strong company. Is it perfect? No, no company is. But this one I think is far and above better than most investors realize. And another thing that, again, I want to repeat about this company is it's in that vein of Texas Roadhouse, Crocs, Vici, these less followed companies. These ones don't have a million analysts looking at them. Pool Corp basically has no attention in any type of analysis website because it's not the biggest, most glamorous company. So these smaller companies that are really good, I think are unique finds. Now, the valuation of the company, I also think is decent. I plugged it into my discounted cash flow calculator. This isn't perfect. It doesn't factor in all the risks inherent in the business. But when I do some basic assumptions, I give it a discount rate, a very moderate revenue growth rate, and then I don't even add in any marginal expansion, which I think is very conservative because they're going to expand margins in the future. I get a valuation where it's 26% undervalued today. Even when I plug in more conservative estimates, I still have it at below fair value. So I also like the valuation of the company as well. Now, even though I like all of that, there's still risk to this company. I'm not recommending that you go out and buy this company because it is a volatile one. It trades around like crazy and it's not suitable for everybody's portfolio. In my case, I'm doing a specific buying strategy with this company where I buy in a small holding at the beginning, $1,900. And then because I believe there is a real material risk to Pool Corp, if earnings get revised lower, if the economy slows down and people no longer want to maintain their pools and buy new pools, I think that is a real risk. So I'm respecting that risk and I'm not buying in super heavily right now. What I plan on doing is dollar cost averaging in through the remainder of this year. That makes it so that if the company trades down and down and down, I can get it at a lower price and lower my average share price and own more and more of the company. If it trades up like crazy and I get 50% gains, then I'm going to stop dollar cost averaging. So I'm basically going to DCA into the company. If it trades flat or down, I'll continue to buy more. If it trades up, I'm just going to hold. That's my buying strategy, and that's how I'm going to eliminate a lot of risk with this position. So there it is, the new holding to the portfolio. Let me know what you think. And sorry about the joke earlier, Palantir investors. Maybe someday I'll own the company. That's all for now. I'll see you in the next one.